Friday, August 2nd, 2024, Monaco 64, home of alternative economics and contrarian views. Hi, Clive. How are you?
Hello. Good morning, Mario. Yesterday in Switzerland, where I am, was the Swiss National Day, the 1st of August, and they let off the fireworks, and we were down by the beach being the beach on Lake Geneva. We don't actually have any access to the sea from Switzerland, and they had a big bonfire and all sorts of things with barbecues and so forth. So
Yeah,
nice to see you.
yeah, nice to see you too. I remember the 1st of August is a big day in Switzerland. It's like the 4th of July. Um, we're gonna cover quite a few subjects today, but one thing I wanted to tell the viewers, and we're gonna cover this later on, and I think it's quite important, is that the Japanese yen, if you've noticed in the last few weeks, it has appreciated a lot. The dollar has come down from around 160 to below 150, and mainly because the Bank of Japan has been intervening, and also because 2 days ago they raised rates, and they also announced they're going to taper their QE. And I've always spoken about the Japanese yen carry trade. I have a playlist if you want to look at it. I've been talking about it for years, and I've always said that if the Bank of Japan uh, abandons the weak yen policy and starts raising rates, it could have a huge repercussions for not just for the Japanese markets, but for the whole world markets everywhere, because the Japanese yen has been used as a financing tool that people borrow in yen for very little, and they buy assets in dollars, euros, and pounds. So if that's reversed, it's a big danger. And we've seen today, Clive, that the Nikkei in Japan dropped 5.7%, or over 2,100 points. So it's taking a couple of days for the markets to react, and we've seen that the markets in the US have been under pressure. So yeah, I think we need to keep an eye on that. So what do you think about the yen and what's happening?
Well, as the interest rate differential between the US dollar bonds and Japanese bonds narrows, and that's what's happening because Japanese interest rates are rising and US interest rates are falling, therefore the differential interest rate gets narrower and narrower. It becomes less and less attractive. In fact, it's currently unattractive to do the carry trade. The carry trade is where you borrow money in one currency and invest it in the bonds of another currency to capture that higher rate of interest. So that's being unwound. And that basically means that Japanese investors are probably, not just Japanese investors, but it could be hedge funds too, but anybody who happens to have done this carry trade, they would have borrowed yen and bought probably US treasuries. They'll be unwinding that position and selling treasuries at the moment. But of course, those who didn't have a hedged position will be, as they sell the treasuries, will be paying off their Japanese loans. And that means they will have to sell dollars and buy Japanese yen, which explains why the yen is rising. And of course, a higher yen then explains why the Japanese stock market is falling, because when the yen is low, it means that Japanese exports are more attractive to foreign buyers of Japanese goods. But if the yen rises, as is currently happening and has been happening for a few weeks now, then it starts to make Japanese goods seem more expensive, and therefore it's harder, or there's less exports and therefore less profits for Japanese companies. So I think that explains why the Japanese stock market is down. I see on my screen, I'm looking at the Japan 225 index, and it's down nearly 3% today. I'm very happy about that, Mario, because I'm playing a game on TradingView. They set up a trading game which started yesterday, where you could buy or sell anything, but they have limits as to how much you've got to buy. But I've gone short on paper, not in real money, the Japanese stock market to the maximum allowed by the game, and I've gone long gold to the maximum allowed by the game, and both of those positions are showing a nice profit at the moment.
Yeah, and yeah, you can see here the market closed at 7 a.m. London, the Nikkei, and then it keeps trading. So I don't know. It might let's see, it might be down further after the close. Oh yeah, as you can see here, it's down further on the futures market, down another 225 points, the Nikkei. But yeah, and it affects every market. You can see here, live in the viewers, the Dow is down 270, the Nasdaq is down 320, and the S&P is down 57. So this is having an impact everywhere. And the worst thing, I guess, that could happen, if this continues, would be for the BOJ to backtrack and say, we're going to stop, we're not going to raise rates anymore, and we're going to keep the yen weak. And that would, they would lose a lot of credibility. Or weren't you talking, Clive, the other day about the fact that you think the Fed might have to do intra-meeting cut?
Yeah, so obviously the expectation we didn't have a cut on 31st of July, and I think nobody was expecting that. And the next decision is due in September, and the vast majority of people are expecting at least a cut in September, followed by almost certainly a second cut, if not a third cut this year. However, if the inflation numbers come in better better than expected or very good, and we see further progress towards the 2% target of the Fed's measure of inflation, or if we have a bad unemployment number in the meantime, we might have an emergency cut. So I'll give it an outside chance. I will say maybe it's a 5 to 10% probability that we get an emergency cut before the September meeting. And then, of course, if that does happen, people will say, what does the Fed know that we don't? Are we heading into a recession? On the other hand, the promise of a cut in September, as we stand, has been up until now, but not this week, of course, because we're falling stock market. But up until recently, it's been keeping the stock market alive because people are hanging on to their stocks, expecting them to go higher when the Fed does cut in September. But there's no clear 100% guaranteed correlation between interest rates and stock markets, or the gold price for that matter. It's just sort of natural economics to say when you lower interest rates, the price of everything rises.
Yeah, but and also with what's going on in the markets now with the yen, it could snowball, and we could have a major drop in the stock markets, and they might have come in.
Well, I think that would be one of the triggers for the Fed to have an emergency cut. If we do have a collapse in the stock market, which we talked about several times in the last few weeks, if that collapse comes, and we are down 5 or 6% already, we need another 15%, maybe. I may have got the numbers slightly wrong, but to get to a bear market. A bear market is when the stocks are down 20%. And I'm quite sure that if we start to look like we're having a bear market, the Fed will feel that it's under great pressure to cut the rates before we get to September.
Yeah, and you're talking about the economy. Yesterday, we had the manufacturing PMI numbers, and we'll go through them quickly here. You can see that the whole number, let's see, came out 46.8. It dropped from 48.5, so it dropped by 1.7. And that means when it's below 50, these PMI, purchasing managers index, they go around asking purchasing managers whether business is contracting, unchanged, or expanding. So that's not a good sign. And the new orders were also down. Production was down. Employment was down. Supply deliveries were up. Inventories were down a bit. But the one that caught my attention is prices. Prices went up. So everything, the economy, the manufacturing sector is contracting, but prices are still rising. And that's a problem, I think, for the Fed. But they might ignore that and the prices and still cut. I don't think they're going to make a big deal out of it. So, Clive, we wanted to talk as well about Bitcoin, because there's a senator, and I'll bring this video up. I'm not going to play the video, but just to show.
Cynthia Loomis.
Yeah, I think she's from Wyoming. She's proposing to build a U.S. Bitcoin reserve. What do you think about that?
I haven't been able to find the draft bill, which is, as of yesterday, was not on the US website where they normally put up draft bills, but she's been talking about it. Um, I think the more interesting, or one of the very interesting part of the plans is where they're going to get the money from. And as you can imagine, with the US, they've found a way to magic up some money out of thin air. At least she has. Um, so the main idea is to buy some Bitcoin, and she says that we won't be using taxpayer money, but this is what we'll do. As we all know, the Federal Reserve owns some notes. They're called gold notes. But they are not gold, and the Federal Reserve has no right to the gold. But those gold notes were issued to the Federal Reserve by the Treasury, that's the government, back in 1934 in exchange for the Federal Reserve's gold, which at the time was worth $20. So the Federal Reserve at the time got these gold notes at the official gold price. Now, the official gold price was then raised to $35 and more recently 40. When I say more recently, I'm talking about the 1970s. Officially, it's $42.22 or something like that.
That's right.
So those gold notes are redeemable as we stand in dollars at that price, at $42, not at the official gold price, because they're lawful currency notes. In other words, dollar notes, even though they've got the word gold attached to them. The proposal that she's put forward is that they arrange to exchange the Federal Reserve notes for new gold notes, but based on the current gold price of $2,400. So that would take the value of the Federal Reserve's gold note holding from 11 billion, which it is at the moment, 11 billion US dollars. It would take it up to a figure of $627 billion, which is a nice profit for the Federal Reserve. And as we all know, the Federal Reserve by law has to pay almost all of its profit to the US government. So if they change those gold notes from 11 billion to 627 billion, the Federal Reserve would have a nice profit, which would then have to pay to the US government. So it would print 620 or $600 billion or so and pay that to the US government, which the US government could then use to buy the strategic reserve of Bitcoin. The proposal that she's put forward is that the US government use all of the Bitcoin which it currently owns, which is about 1% of the total supply of Bitcoin. Basically, that's Bitcoin which the government has seized from various criminals and wrongdoings and so forth. Put that into the strategic reserve and keep buying Bitcoin for the next 5 years until the government owns the same amount of Bitcoin in percentage terms, which is 5%, as they own of the gold market. So the US government currently has 8,300 tons of gold. That corresponds to the figure of the $11 billion. And that represents 5% of the gold of the total gold out there. They're proposing that they ultimately would own 5% of all the Bitcoin. That would be about 1 million Bitcoin that they would ultimately own, I think. Is that for 20 times? Yeah, 5. Yeah, that'd be about, out of the 21 million, it'd be about 1 million Bitcoin. Now, I don't know if this bill will make any progress. There's a lot of water to go under the bridge, and there'd be a lot of education required of various senators and so forth before they're going to approve anything like this, because there's still a lot of anti-Bitcoin feeling. But what I found, if we put the Bitcoin bit to one side, what is quite interesting is the idea that they can magically force the hand of the Fed to print money. And the Fed is supposed to be independent, but over the years, over countless years, the government has intervened and told the Fed what to do, and it's bowed down and obeyed quite nicely. A good example of that was in 1934, where I'm going to use inverted commas here because they use the word authorized the Fed to buy a bunch of government bonds. Effectively it was an order, though. So that's what they did, and we all know that from the 1930s at least through to the 1950s, the Fed was pretty much doing as it was told. I mean, one of the key things in those years was it was under orders to keep interest rates low. So effectively, they were doing what the Japanese are doing at the moment. They were engaging in yield curve control. They had to keep the T-bill rate at 0.3%, and they had to keep the long-term treasuries capped at 2.5%. But the problem with that was the Fed was effectively to do that having to intervene in the market and buy more and more treasuries to stop the yield going above 2.5%. Meanwhile, the government was borrowing money like there was no tomorrow to finance wars. I think the Korean War and other wars were going on. So what that did was increase the quantity of money in circulation. And what did that do to the inflation rate back in the 1940s and 1950s? Well, the inflation rate in 1946-47 was about 17.6%. By 1948, it had dropped to 9.5%. But 1951, it was up to 21% in the USA. And that was all caused by the fact that the Federal Reserve was being effectively forced to print money by the policies of the time. Now, if we get into the situation where they start to revalue the gold notes and basically say to the Federal Reserve, now you've got a profit, you've got to hand it over to the Treasury, well, they're being forced into printing once again. But I think the interesting thing is she's talking about revaluing the gold at the current price of $2,400. Well, I'm saying why that's only going to produce $600 billion compared with a national debt of 35 trillion.
Well,
I'm saying why not a higher number?
Sorry to interrupt you, because this figure 600 billion doesn't even match the current non-realized losses the Fed's sitting on, which is like $1 trillion. So
that's right.
So they couldn't even pay the Treasury any profits because they're losing $1 trillion on their treasuries and mortgage-backed securities. So I think you'd need a much higher gold price. And the thing about this $42.22, which is they call it also the statutory price, that has to be approved by Congress to lift that price. The other thing that would do, and I think it's one of the reasons they've kept that price at 42.22 for 50 years, that would suddenly wake people up, and they'd realize how gold is important. Because I think they've kept that price at 42.22 just to say, look, it doesn't really matter where gold is. The Fed doesn't care. And it could be a backdoor as well of reliquifying the Fed, seeing that they're sitting on so much losses. So I think 2,400 would be a silly price. I think they probably want a lot more. So it would kill two birds with one stone. It would keep the Fed solvent, and would make the Congress happy, because there would be a lot of money to cover all the unfunded liabilities for a few years. And people would, and like you said earlier, Clive, everyone going into Bitcoin or maybe even gold, that would raise capital gains taxes. They would get loads of, but it would be so inflationary. That's the thing.
I've done a bit of maths on how high they'd have to put the gold price to do various things. So first of all, if they wanted to cover next year's spending, that is their budget deficit by the rise in price of gold, they need to put the gold price at $10,000. That would make their gold holdings worth 2.6 billion, which is about right to cover the deficit of next year.
Trillion, isn't it, Clive?
Big on 2,600 billion, which is 2.6 trillion, which is what their deficit will be. But if they wanted to have enough to cover the national debt, which is a promise to print money down the line, they need to put it, we've got a national debt which has just gone through 35 trillion. They need to put the gold price at $135,000. So there's a long way to go and a lot of upside if they go in that direction. Now, just going back to Cynthia Loomis's proposal with the Bitcoin, which also involves gold, the whole idea of what she's proposing is that they will have enough money to pay off the national debt in 20 years' time, according to her.
All right. Yeah. I don't know how she can see that far away, but sounds like a good plan. But when
Yeah.
work, I don't know. And Clive, talking about bonds, because even though the carry trade seems to be a little bit under pressure, we saw the 10-year yield, US 10-year yield yesterday, or the day before, drop below 4% right now. I'll show you here, and the viewers. Let me share the screen. We've got, so here we go. The 10-year yield is now at 394, 3.9. So it's down another 3 basis points. So that means that people are buying treasuries or bonds because I think, as you can see here, the stock market as well is under pressure. Dow is down another 280, NASDAQ 339. So they're going to treasuries because the government can always print the money to pay its creditors. But the other way I look at it, Clive, is I look at the price of gold here versus the 10-year note. So this is just the price of gold divided by the price of the 10-year note, the current 10-year note going back to 2000. So it looks very similar to the gold price, spot gold price. And it's not surprising because treasuries are just the dollar with a little bit of, a loan attached to it. And to me, this looks pretty bullish. And what I'm trying to say here, yes, bonds might be going up and yields might be going down, but I think you're going to miss the real value here, which is gold. Gold is going to do it, going to go up even faster than treasuries. What do you think, Clive?
Um, well, I worked for 47 years in the wealth management industry, and we always had behind the scenes the asset allocators who decided how much equities versus bonds should go into the discretionary portfolios.
Yeah.
And if you talk about the typical average being 60-40, 60 equities, 40 bonds, or could be the other way around, depending on the risk approach of the client, those numbers would get adjusted up and down every year based on the economic cycle. So when it was perceived that equity prices were high, they'd allocate more money to the bond market and reduce the equity market, and vice versa. So what I think is going on in the wealth management industry, which controls the world's pension funds and your retirement savings, and of course any funds that you've generated from your business, which are surplus to your business needs. I think that the asset allocators are saying that stock markets have got a little bit ahead of themselves. They're pulling money from the biggest stocks in America. They're putting it into US treasuries as a parking place while they wait it out and hope to buy back at a lower price down the line. So money's flowing into treasuries. Now, the question is, what's happening with gold in all that? When I started work in Switzerland, that was 1985. It was quite a few years after I'd started work. I started in 75, but I arrived in Switzerland in 1985. At that time, a typical portfolio would have exposure of around 5% to gold. By the time I retired, which was 2021, the asset allocation across the board in most Swiss banks was recommended at 0. Now, it wasn't every bank was at 0. And where I worked, we had a latitude that you could be within 5% of the official number. So typically for my clients, I pushed the number to the maximum 5% gold, which was, with hindsight, if they still have it, a good thing. I don't know if they have it because, of course, I'm retired now. But what I've seen recently in the last couple of months, I've seen several banks issue new advisories adding gold to the portfolio. Now, the amounts they're adding is not very big. I don't think they're anywhere near the 5% they had traditionally back in 1985. But for example, UBS and I think JP Morgan have put it at their as one of their most preferred assets now. Most preferred doesn't mean to say they're going to put half the client portfolio in. It means they're going to add more. They're going to have more than zero, because that's where they're coming from, and they're probably pushing it to 2 or 3%. But there's going to be thousands of other asset managers and banks who are still at zero and are still trying to make up their mind when to move some money into gold. So if we have any sort of hiccup politically, economically, or with the bond market, I think there might be a sudden realization that perhaps some of that money should be allocated towards gold, in which case gold being such a tiny, tiny part of the global markets, there's a long way for it to go.
Yeah, and the other thing I wanted to show the viewers is the price of gold in pounds, which is approaching an all-time high here, which was, let's see, in April at 1954. We're at 1937 right now. And Clive, the other thing I wanted to cover quickly before we move into some other subjects is this here, and I'm going to bring let's see, the gold chart here. And so here we've got spot gold, it says, right? And we're at 2462. And I've been hearing or seeing on X and other places, like yesterday, people are saying, oh, gold hits all-time high above 2500. The problem with that is that they're looking at the future, which right now is the December future for gold. That's the most traded future. So if I click here, future, it brings the December gold, right? December 2024. So yes, it's above 2,500. And it's not an all-time high either, because the all-time high in the December futures was here at, let's see, 2,540. So, and people are puzzled as to why there's such a big premium. And it's really simple, because I worked in the futures market for 20 years. So what happens, Clive, and you probably know this, when you buy a future, let's say today, beginning of August, and the first delivery day, first notice day is in the beginning of December, because that's when the December future, that's when it happens. You've got about 4 months. So let's say you bought gold today, and you paid 2,460, but you only take delivery of it in 3 months' time. So you're giving up 5%, because that's what you get right now for let's say that's what you get for a 6-month bill or a 3-month bill. You get about 5%. So you're giving up 5% on that 2,460, which is about $40 over 4 months. You have to do the calculation divided by 3, because it's not 12 months. And if you add that 40 to the current price, spot price, you get 2507, which is just about right. And I think you have to add as well the cost of someone who's keeping that gold for you until December has to store it. So there's a little storage fee. So there's nothing really unusual about this. And I think the reason people are shocked at this premium, which is like over $40, is that for the last 15 years, when rates were at zero or close to zero, the premiums, the futures premiums were very low, because there was no cost of carrying that gold. But now with the price a lot higher and interest rates a lot higher, that's why we got this premium. Just wanted to put that out there, Clive.
Yeah. So in the simplest terms, the future price of gold, when you're buying a future, is equal to the current price plus the short-term interest rate minus the cost of storage over that period, which obviously cost of storage being roughly zero means that it's basically the current price plus the interest rate until the future date.
Yeah, it's the interest rate that you forego by buying that gold and leaving it there with someone else. You could have put that money on deposit, and you lose out on the $40. So,
but the futures price does not actually tell us what the future price will be. It's not a forecaster of the future price, as many people think.
That's right. It doesn't mean that December gold will be above 2,500 because the spot price could drop to 2,200 and the futures price will in December be around 2,200 as well because there will be very little time left. Um, what else were we going to talk about, Clive?
Well, there was this property sale went
Oh
through
yeah,
in New York, wasn't there, for a massive loss. You want to talk about that, Mario?
definitely. And I saw this yesterday. Someone posted it on X. And as you know, I've got, not that I think much of the New York Times, but I've got a subscription for a year for $20 because I wanted to access their archives, which are really good. And you can go back decades. And I was looking some months ago at the petrodollar agreement from 1974. But anyway, this is the story here that came out. Let's see the date. Well, yesterday. Uh, this 23 floor Manhattan office building just sold at a 97.5% discount. The sale price of 135 West 50th Street in Midtown, which is only 35% full, was a sign of how much the pandemic appended the market for office buildings in New York City. So I'll give the viewers a quick summary here, and then you can chime in, Clive. So as it as you can see here, it was the last time it was sold, it was for $332 million in '06. And on Wednesday, they sold it at on an online auction for $8.5 million. Yes, $8.5 million. And
Apparently, there was only one bidder.
yeah, and unfortunately, the big loser here is UBS Bank or UBS Realty Inc. So, do you want to? What do you say, Clive?
Well, I think this is a reflection of commercial real estate everywhere. Um, I, at the end of the day, many office blocks all around the world are not as full as they were pre-pandemic because people have found a new way of working. The pandemic accelerated that. Suddenly we discovered the concept of working from home. And I can see that where I live here. The railway station used to be full every day, especially on Fridays. It's at best two-thirds full, sometimes only half full, especially during the summer. Talking about the parking spaces. So there are less people for sure working in the office. And I do speak with my little boys going to school here. I speak with the mums and dads around, and almost everybody, not everybody, but almost everybody is doing a number of days at home. So people who are renting offices are saying, why are we renting 5 floors where we could fit everybody in 2 floors? And also, we've got in the modern age, we've got something called hot desking. That's another new technology. It's not that new, but hot desking basically means 2 people can use the same computer. They don't have to have their own desk because we now live in this what's called the paperless age. When I was working in 2021, we had paperless desks. We weren't supposed to have any paper on our desks because everything was scanned and dealt with on your machine. So you never saw any paper. You didn't need any cupboards. You didn't need you theoretically didn't need any drawers except maybe to keep your pencils. So hot desking is becoming more and more of a reality, which means that at any moment in time, there's going to be some people who are not in the office because they're on business trips or they're sick or working from home, which means those who are don't have to sit at their desk. You don't need a space for them specifically. They can sit at any empty desk and do their work. So that means that probably for the typical office, the amount of space needed is at best half what it was. And what did they say? This building was only did they say it was only 1/3 occupied at the moment, something like that. So what's happening now is the rents are probably coming in at 1/3 of the rate. Those tenants who are still in there, when those leases reach maturity, they'll be saying to their landlord, "Look, first of all, we want less space anyway, and secondly, we don't see why we should pay as much rent, seeing as there's 100 other buildings in the same street, all desperate to get tenants. Please reduce our rent." So rents are going down, and the problem for the landlord, the owner of the property, is that he will have expenses. Not only will he have to pay city taxes and things like that, but in this particular case, there's the ground rent because they own the building, but not the land beneath the building, which means they're paying rent to the owner of the land. And I read somewhere in that article that the rent they're paying to the owner of the land is less than they're currently collecting from the tenants. So
Yeah.
it's whoever bought it has got to come up with a lot of cash just to keep the building standing.
Yeah, and I think they said as well in the article that one of the options is to redo the building for it to become residential, or bring just knock the building down and build a new building like a residential or a hotel, but that would cost hundreds of millions. And I think, Clive, the other important thing about this story, and is that it's a little bit like, let's say you live on the street here in the UK. There's always signs for sale, sold, and people are always checking the prices. It's like a national hobby in the UK to check house prices. And even the Daily Mail, when they talk about people, oh, he lived in a £1 million house. But let's say in a street where people think their houses are worth 1 million, and someone for some reason has to sell their house and sells it for 200,000. That's going to be a trigger. And I think it could be a trigger for all the other commercial real estate loans that I think the banks are keeping artificially high, because it's going to be very hard to hide the fact that this building, went from $330 million to $8.5 million. And did you read as well that they have a kind of eBay auction site, similar, online auction for the building? There's a lot of other buildings. This building was just one of the buildings. And I think when there was one bid that was put in at 7.5 million. And then when the auction started, there was a minute left or something, and they raised it to 8.5, but it was still not they hadn't met the reserve. But then it went green, and the reason it went green and it went through is the sellers changed the reserve, so they're really desperate.
Yeah, I mean, I think that what this shows is the jiggery-pokery which goes on in online auctions. The reason they left the reserve price not met up until almost the very last minute was in the hope that the bidder, who'd bid 7.5 million and then increased his bid to 8.5 million, would keep increasing his bid until the reserve was met. But they fully intended to take his bid whatever they could get. So by they were in. I mean, there may be some suspicious behavior here, but they were basically enticing the potential buyer in what's supposed to be an open auction to raise his bid over and above what he was willing to pay in an open and free market where other people could have bid. And at the very last minute, they moved that reserve price downwards so that his bid was in fact met.
The other thing that I thought was not really kosher, so to speak, was the fact that in the auction they extended the time that you could bid. In the normal auction, I always thought that once the hammer is hit and it's finished, you can't bid anymore. So yeah, these online auctions seem to be a bit of dodgy at best. But I think it was owned by UBS Realty Inc. What I think it could do is it could affect all the other financial institutions that have realty companies or hedge funds, private equity. It could be another flake on that hits the snow and starts the avalanche. I don't know.
Yeah, I mean, you've got to ask yourself, if this one is worth so much less, how much are all the other properties on which the various banks have lent money? how much less are they worth? Now, perhaps they don't have the same dynamics in terms of outgoings exceeding incomings, and I imagine that was the reason why UBS Realty investors had to sell it. They didn't want to hang on to an asset which was actually costing them money, which they probably didn't have handy because they couldn't raise any more money from there. Because don't forget, UBS Realty investors, is it investors or income? Not sure. They probably couldn't raise any more money from their investors. They wouldn't be willing to put up money. So they're draining cash because they're paying out more than they're getting in, and that can't continue, or they sooner or later run out of cash. So the only option is to sell it at any price. I mean, they could have even sold it for a negative price, and they might have had to if the push came to the shove, so they wouldn't have to keep funding these outgoings. But of course, when you look at it, there must be thousands, tens of thousands of properties all over the world in exactly the same situation, where the money. This won't just be in property funds like this was a property fund, but you can imagine banks have lent money to companies and individuals who've bought properties, but those companies and individuals are now looking at their properties, and in some cases they're saying, gosh, so many tenants have left, we can't pay the outgoings, and we've got the interest to pay. What are we going to do? They're going to hand the keys back to the bank, and then the bank's going to be forced to sell that property in an auction at a fraction of what it was originally worth, driving prices for commercial property down in general. But the problem with that, it means that we're going to have more and more banks whose assets, i.e. the loans they have made, aren't worth the amount of the loan because the property, which is acting as security, isn't worth as much as the loan.
Yeah, so
that could lead to more banking insolvencies and crises, and that's why I think one has to be cautious about how much physical cash you keep on deposit with a bank. Of course, it's the safest place to put your cash for what you need, but beyond that, I wouldn't put your life savings in one place. Diversify.
yeah, and talking about banks and the fact that they could be in danger because when you put cash in the bank or leave cash in the bank, they take that cash and they invest in real estate, everything else. And if those go sour, the bank is at risk. And we saw that last year. And we saw that in the 1930s, Clive, early 1930s in the Great Depression. A lot of banks went bust. It wasn't because the stock market crashed, even though that had an impact. Eventually, it was because all the banks had bad loans, and there's no money around because the Fed and the government weren't as aggressive in creating money out of thin air back then, even though Roosevelt did a bit. But I wanted to, I told you about this book before we started, The Great Depression, a diary. And one of the viewers sent me this, and I'd like to thank the viewer who sent me this. And it's a diary of a lawyer, Benjamin Roth, in Youngstown, Ohio, of the period. He was kind of an investor. He was a lawyer, but he wrote some really good stuff. And I think it was his son and someone else who edited it because he kept all these entries. And I marked one here, Clive, that is really interesting. And it's from August 22nd, 1931. So let me read it to you and you'll see what you think. There is a quiet but steady stream of depositors at every bank in Youngstown this morning, quietly withdrawing their funds. The closing of banks in Toledo and Warren received much publicity, and distrust of all banks is growing like a cancer. It is a movement which feeds on itself and is hard to stop. At the Dollar and Union banks, there are about 4 or 5 depositors at each withdrawal window. There's no excitement, but a quiet look of intensity on the faces of both depositors and bank officials. Even the strongest banks can't keep this up for long. They do not have enough cash to pay everybody. Much of their funds are invested in railroad bonds and other securities which were once considered gilt-edged, but are now selling below par. so that the banks cannot afford to liquidate. Investments like mortgages are frozen tight. There's clearly something wrong with our banking system, which permits such a situation to come about. It is hard to rent a safety box today because there's been such a demand by hoarders. Actually, the liquid cash of the bank is being transferred from the bank vaults to the private safety vaults, where it is taken out of circulation and becomes sterilized. So it's interesting that you are still allowed to go and take your cash out if they had it. Nowadays, a lot of the stuff is done digitally, and yeah, you
What has to be said there is the cash they were withdrawing was gold coins, the eagles and double eagles, the $10 and $20 coin of the time, which was the money prior to 1933. They weren't withdrawing promissory notes from the banks and putting them in safety deposit boxes. That would have made no sense because you would still be exposed to the counterparty risk of the bank. So what the people wanted when they queued up was to get their hands on the physical metal, and that's what went into the safety deposit boxes.
it could have been also I think they had Federal Reserve notes back then or Treasury notes. It could have been those. And I think some banks had their own notes. I think I've got a First National Citibank note from 1931 or something. You wouldn't want those. Like you said, they were probably taking gold. But that was the thing. And it reminded me of what's happening now to the banks, Clive, because they're sitting on huge losses. Um, the FDIC report that came out the last time was 500 billion, and they don't realize those losses because it would bring the whole house of cards down. And but it's really amazing that the problem then was, yeah, there's no money. And
The biggest
Did that
risk to the
happen
banking
again?
system the
Yeah,
biggest risk to the banking system these days is not the man queuing up at the counter to get his money out. It's this. You see what I'm waving?
yeah, the
The
mouse.
mouse.
But
The
the
mouse.
thing is, you take it out of one bank, you put it in another. The thing that you need to do is take it completely out if you don't trust it. But do you think that they would well, this do you think this could happen again, where there's no money around? Do you think the authorities would allow that to happen again, or are they going to continue to print like that senator wants to do, with
Um,
gold and Bitcoin?
I think it will happen, but I think they will print their way out of it. So yes, it will happen. Banks will find themselves insolvent, and some of them will be closed. The insurance funds, which guarantee $100,000 or $250,000 in America, will not be able to pay out because they won't have enough money. But what they will then do is recapitalize these insurance funds and so forth with newly printed money so that they can pay out. So at the end of the day, I don't think people will lose their money, but in nominal terms, but they're going to get their money back. Which is at a rate which is worth a lot less because there'll be a lot more money out there because it's just been printed out of thin air. So I would say you're really running a deflation, a devaluation risk if you're holding any currency to a large extent in a bank. My advice is always hold what you need for, and that depends on the person. If you've got a job, if you've got a regular income, if you've got some other savings, but hold what you need. That could be 1 month to a year's spending money. But beyond that, if you have a large amount of money, let's say you're a millionaire and you've got that much in cash, you can't spend that much usually in a year, can't spend it in 10 years. You've got way too much in cash, and you should have it in other things which are not going to be devalued when the day comes that they have to start printing like mad to bail everybody out.
Yeah, I read a bit more from there. There's a lot of entries, and one thing I took from it, and I haven't finished the book though, is that people who have had speculated, who not saved, uh, even if they had a job, they're in a really tough situation. Like factories were running at 30% capacity. But the people who had saved, and by saving, I don't mean stocks and bonds, I mean real money, gold and silver, they were okay because there are a lot of bargains to be had and you could keep going. So I think the modern day version of that is stacking. So there you go, Clive, for a rainy day. Do you want to end here and then and tell the viewers, uh, where they can find you and anything else you want to tell them?
Sure, Mario. Actually, I'm still a buyer of gold and silver. In fact, 2 or 3 days ago, I managed to acquire a beautiful 5-ounce coin, which is from the Confederation Switzerland. It's produced by Switzerland, but it's part of a collection of towns. So this one's the Zurich coin. I've got quite a few of the 1-ounce coins from that collection of Geneva, Basel, Bern, and so forth. But this is my first Zurich coin, and so I'm very pleased with that one. In terms of finding me, anyone can find me on LinkedIn. That's the only place I'm publishing. I'm writing a few articles a week on LinkedIn, and you're welcome to connect to me. I'll accept your connection request, and then you can ask me any questions or whatever you like.
Yeah, it's Clive Thompson. And that 5-ounce coin, is that silver or gold, Clive?
It's silver. I didn't have the, well, I wish they would have had a gold one, but they don't. That would be a lot harder to find.
Yeah, I think they've minted, the Royal Mint has minted before a 1 kilo gold coin, which is quite interesting, worth
Oh
quite.
yeah, these larger size coins do exist for the major collections, but most people want to buy the small coins, the 1 ounces. That's the most popular everywhere. So most of whether it be silver or gold, most of the coins minted are 1 ounce. And if you want to be a really avid collector, you could get the 5 ounce or the 10 ounce or even the 1 kilo version.
Yeah, and I also in the UK, I recommend the sovereigns, which are 0.2354 of a troy ounce. So, Clive, I wish you a great weekend and the viewers as well. And we'll talk soon.
Thanks, Mario. Have a lovely weekend, and all your viewers too.